And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani, joined today by Jay Jacobs of Global X Funds, Tim Seymour of Seymour Asset Management, Will Rhind, CEO of GraniteShares. Let's kick it off by taking a look at the third quarter. Third quarter saw heavy inflows into defensive sectors, and particularly gold and long-term treasuries getting a boost. Utilities and consumer staples continuing to outperform after stumbling briefly in September. Meanwhile, trade-sensitive cyclical names like metals, energy, materials, retail, they all lagged, along with healthcare. That got dragged down by biotech. So what's next as we gear up for the fourth quarter? Will, you run the GraniteShares Gold ETF, the symbol BAR here. Gold's outperformance really sticks out for this quarter. Is that going to continue into the fourth quarter?
I think it is. We've seen this trend from the beginning of the year in the U.S. of interest rates coming down. Interest rates are coming down across the world. That's not a great thing for anybody in the fixed income market, but for those looking for more defensive positioning, gold is something that's really benefited from that. The China trade talks, more broader uncertainty, just helping along that story.
And Jay, how does the Federal Reserve fix? And sometimes people feel there's a relationship between interest rates or the direction of interest rates that the Fed's guiding us in gold stocks. Do you see any relationship? Does that matter?
Yeah, absolutely. The more that the Fed cuts rates, the more attractive gold as a zero-yielding asset class becomes. And it's not just gold, it's silver, it's other precious metals where people like the defensive properties. But if interest rates aren't paying anything, it doesn't hurt that much to hold gold or silver.
So what are you telling your people now on gold?
Well, it's interesting also, what these guys aren't talking about is a technical argument for gold, too. I mean, gold took, 3-4 years to consolidate through a level that had been major resistance. And you can make an argument, you look at the rest of the precious metal space, and it's alive and well. So, I mean, palladium's at all-time highs. People are playing gold-silver ratios. The one caveat to this, though, I think, is if you have this sense that we may have had that blow off top, and I'm not necessarily making that call, in August in terms of rates where we got to those lows, I think that's going to be a headwind for gold in the short term. The same factors that I think these guys are talking about are probably medium to longer term dynamics that I don't think are going to change. I
guess the biggest problem I have with gold, Will, is it's sort of whatever anybody thinks it is. So years ago, it was a hedge against inflation. Now there's no inflation, so now it's a defensive play against chaos in the world. You could sort of make it whatever you want to make it, right?
I suppose at some level.
As an alternative investment.
Yeah, as an alternative currency, I think that's kind of the main role for gold in the modern portfolio. And thinking about gold and its correlations, the strongest one over time has been its negative correlation with the dollar. And obviously what we're seeing is a world where central banks are out easing again in Europe and elsewhere around the world. The US is cutting rates. All of that from a real interest rate perspective has a real correlation with gold. So real interest rates fall and gold prices typically tend to rise. And as Jay was saying, and Tim, when you have $18 trillion worth of government bonds around the world yielding less than zero or yielding less than gold, the opportunity cost of holding gold only increases.
Yeah. Speaking of negative yielding assets, the TLT, which is the 20-plus Treasury, long-term Treasuries, the biggest outperformer of all this quarter. Who would have guessed that one? 7.5%. Not even including the yields on that. How long? We keep talking about a top in Treasury yields. It should have happened.
Maybe 4 decades going in this conversation.
Yeah, it hasn't happened yet. Your thoughts?
My view is that if you look at the PMIs and the leading indicators and all the macro around the world, it tells you that rates probably need to go lower. The question is, how far ahead of the market did yield curves around the world get as a function, really, of the ECB? And negative 50 bips on the Bund, I think I would make an argument that pulled our rates down. And I know people have a tough time believing that the Fed is the tail and the ECB is the dog, but I think rates got ahead of themselves. The U.S. economy is going to print 1.5% to 2%. This is not a negative yielding environment.
Yeah, there shouldn't be, right? We shouldn't have a negative yielding environment, right? Well, and it doesn't make sense to me. I have a hard time explaining it to my mother, who says, Robert, I heard you say that Germany had negative yields. How is that possible? You're giving money to the government for 10 years and you're losing money. And it's hard to explain.
Does she call you Robert?
It doesn't, Robert. Yeah, it doesn't really make sense. You can't explain it to your mom very well.
It makes no sense. And look at the impact. What no one's really talking about is how negative this is for the banking system. Look what negative interest rates have done to Europe and the banking system in Europe. We've got serious issues with Deutsche Bank that everybody knows, with Commerzbank, so reared its head last week. So, what we're not really talking about is the real negative impacts this creates on the banking system, and I think society more broader in terms of everybody looking to save.
I completely agree with you. When I can't explain it to my mother, I get really worried because, she asked the right question. Robert, explain it to me, and I had a hard time with it.